Welcome back to Click Capital, your go-to YouTube channel for all the latest daily fundamental and technical analysis of the markets. If you're new to this channel, hit that subscribe button and I'll keep you updated every day after market close with all the most important data, events and charts of the day. And it looks like we've just lost another bank, First Republic Bank, getting absolutely smashed in the after hours as I speak. We're down at $2.10 a share. We started the week on Monday getting up to $16 a share, and we closed down another 43% today, down to $3.50, and is getting absolutely whacked again in the after hours on reports that the FDIC is going to step in and take over this bank as they've been unable to find a rescue deal or a buyer. And this came on the back of their news on earnings. They lost over 40% of their deposits, and that was with a $30 billion injection from the top 11 banks in the country. Wasn't enough to keep them alive. However, First Republic going under doesn't appear to be sparking contagion, as we actually had the regional banking ETF finish up 1.7% today and is only down a little bit in the after hours. And the big bank financial sector ETF XLF is still trading fine, well above its 50-bar average. So First Republic going under doesn't appear to be spooking the market all that much. We did see Amazon report after the bell yesterday, and even though they beat on numbers, they gave weaker guidance on their AWS unit, which they said is currently only growing around 10%, and that's down from about 30% last year. So we saw Amazon stock come off 4% today, and if we just go out to a weekly chart here, we can see it's stalled out in this big resistance zone around 105 where we've seen some turns before. And all of mega cap tech had a great week. Apple was up 2.8% today, but it's coming up to its big resistance zone as well. Microsoft was the winner, up 7.52% this week on really good earnings. And it too is at the top of a resistance zone. And we're about halfway through the earnings season, and so far so good. 79% of S&P 500 companies have reported a positive EPS surprise, and 74% have beat on revenue as well. And that's a bit above the long-term average, around 77%. However, the bar was set low with estimates as for this quarter, earnings were expected to decline another 6.7% like they did in the last quarter. And so far for this Q1 23 reporting season, earnings are only down 3.7% so far. And that is the second consecutive quarter of declining earnings. And we can see here in the dark blue line, the forward 12-month earnings per share has been decreasing for a number of months now. And the forward 12-month PE ratio for the S&P 500 is 18.1, which is only a little bit above the 10-year average of 17.3. However, while the market looks fairly valued compared to its own historical valuations, you can't value stocks in a vacuum. You've got to value them relative to the risk-free rate you can earn on government bonds. And right now, the yield on stock earnings versus bond yields is some of the worst it's been in 20 years, meaning relative to bonds, stocks are still very expensive. And over to the heat map today, another sea of green out there, apart from Amazon, which was down 4%. Pretty much every other sector was green, with many stocks up 1 to 2%. Utilities was the only sector where we saw stocks just come off a little bit. And over to economic data today, the Fed's preferred measure of inflation, the PCE price index, came in at 4.2%, a little bit lower than expected at 4.5, and lower than last reading at 5.1, but still well above the Fed's target of 2%. And the month-over-month change was 0.1%. So inflation data continues to come in a little sideways and a little softer than expected. And since the unemployment rate's still low, we've seen personal income grow 0.3%, but personal spending was flat. And consumer sentiment came in as expected as well. So much like the stock market, economic data is tracking a bit sideways as well. And we're back in the greed zone on the fear and greed index, sitting here at 60 today. The dark pool index sitting at 46%, which is about a neutral zone. And remember, we haven't seen a lot of dark pool buying in this rally over the last couple of weeks. Corporate insider purchases ticked up again a little bit yesterday to 57 versus 51 sales, but still overall pretty low in this rally as well. It was another busy day in the options market with 40.6 million contracts changing hands, 52% of them calls, and a huge 59% of them expiring in 5 days or less. And we did see a lot of activity in First Republic coming in number 5 today at just over 1 million contracts traded, 68% of them at puts. Snap was heavily traded as well, as we saw the stock price come off 17%. Fed Fund futures market has an 83% chance that the Fed will hike rates on Wednesday, and almost a 1 in 4 chance we get another hike in June. Barring any major unforeseen event between now and Wednesday, I think the Fed will hike because the markets are healthy, the stock market's trading high, unemployment's still low, jobs market's healthy, and inflation is still more than double the Fed's 2% target. So they've got all reasons to hike another 25 basis points. As it looks like, even though we've lost another major bank, that doesn't appear to be causing contagion or any widespread fears. It looks quite contained at this stage. And we've got a bunch more important earnings coming next week. On Monday, we'll be looking at MGM and Norwegian Cruise Lines for a read on the consumer. Tuesday, we got Uber and Starbucks. Wednesday, we got CVS, Etsy, and the big one on Thursday will be Apple. We'll be looking to see if Apple can deliver really good results like the other mega cap techs. But the price of Apple's already been rallying and has already been pricing in a good earnings. So if they don't come out with a good earnings, the price may sell off. And then just a few others on Friday as well. Back over to the charts, and another strong day to finish out the month here, with the S&P 500 finishing at 41.69, its highest price of the month and the highest price since it peaked on February 2 at 41.95. And it too is in this big resistance zone. So we're sitting at a real big make or break level in the market here, and we can see the gap between central bank liquidity fair value model has actually grown to over 300 points here. But stick with me and I'll come back to the SP500 at the end to give my final outlook like I always do. Bit mixed across the international stock indices. Canada's TSX coming up to highs but stalling out a bit. The UK FTSE has pulled back a little bit. The German DAX just broke out to new highs today. Same with the Japanese Nikkei. Aussie 200 perking up a little bit, and the China 50 back above its 50-day average as well. The new VIX one-day index is estimating volatility to be low on Monday, currently at 13 points annualized. And we've dived again in volatility, with VIX 9-day down at 15.5 and the VIX 30-day just above it at 15.7, and we've now found a new low for this entire bear market sideways cycle that we're in. And just looking at a weekly chart here on the VIX, we're now at a level that we haven't seen since we were last in the bull market back in 21. So according to the volatility market, everything is fine. There's no problems out there at all, even though we've got bank failures, high inflation, the Fed hiking, growing chances of world wars, record consumer and government debt. It does make you wonder if the VIX really is broken, and that's why we saw the CBOE bring in the VIX one day. And it being a Friday when a lot of options expire, it makes you wonder if the option dealers are somehow suppressing volatility really low, so a lot of the option premium is decayed as much as possible. To be honest, I'm really not sure if that's the case. However, it does make me wonder if that is possible given what we've got the VIX now at 15, which is just super low. And if there was ever a time to buy portfolio insurance for the next couple of months or so, now would be it, with a VIX at 15. And with actual volatility jumping a little bit here back to 12, we've seen that volatility risk premium come back a little bit to 3.6 points. Bond market volatility relative to stock market volatility though is still as elevated as it's nearly ever been. The last time we saw it higher than where it is now was back in the global financial crisis in October 2008. And still a lot of people buying calls out there. We can see that with the low put call ratio at 0.92. And breadth has jumped again with 55% of stocks above their 20-day average, but still nowhere near its highs like the main indices are, especially with stocks above their 200-day average, the long-term moving average. It's just gone back above 50 to 54%. And that's come off significantly since it peaked in February 2. So that's a big divergence between market breadth and the market indices themselves, which are nearing new year-to-date highs. The amount of stocks making new highs is still tracking sideways as well, with 55 on the NYSE and 37 on the NASDAQ today, so that's not breaking out either. Growth cyclical sectors versus defensive sectors are still below their 50-day, and high beta versus low volatility stocks as well. Growth versus value stocks kind of tracking sideways here, same with NASDAQ versus SP. And inflation expectations as measured by the inflation protected treasuries versus normal treasuries back under its 50 today. And we saw government bond yields pull back a little bit today on that softer inflation and personal spending data. Got the 2-year at 4% and the 10-year came off a bit today back into its major support zone around 340%. June and September Fed Fund futures still above 5% though. And the TLT continuing with this pinball bouncing action tracking sideways back above its 50 again here today. High yield appears to be holding on as well. Dollar holding its big support zone around 101.50 and Bitcoin consolidating around a big zone too at 30,000 a coin. A nice little bounce in the commodity index here today, back above its 50. Gold continues to hover around $2,000 an ounce, just pulling back to its 50. And a nice bump up in crude today, back above its 50 to $76 And over to stock sectors, only 3 negative sectors today. That was bots, gold miners, and utilities, just off a little bit. Saw a nice bounce back up in the transports, industrials as well, and energy had a nice move up along with oil and gas as well. And the really high valued stocks that the ARK ETF owns just trading really weak here, was only up 0.6% today. BlackRock back above its 50. Tesla had a little bounce here today, and we'll be looking to see whether it can defend this zone here around 170 or may come and fill this gap. However, I think this earnings gap down on volume is significant, and we are still going to be in a downtrend for Tesla. NVDA had a little pop here today, but still tracking sideways. And out of all the meme stocks, Snap got whacked here today, down 17% after reporting their earnings. They lost another 21 cents a share. And I don't think this company's ever had a profitable quarter in its whole life. So in the tech sector, the winners take all the spoils and everyone else is kind of getting left behind. First Solar finished the day down 9% after reporting much worse than expected earnings, and we're short this one in our portfolio for our clients. As we continue to believe it's overvalued, our stock fair value indicator has got fair value at $105 per share. So we're still 72% above that. And if you want to get access to this indicator stock fair value on TradingView, just click the link in the description of this video to head on to our website. And you can use it to work out what a fair value is on every stock around the world. And the basic idea is you want to sell short stocks that are highly overvalued and buy stocks that are highly undervalued, and then exit the investment when it comes back to fair value. And you can set up an alert on the indicator by coming here, clicking on add alert, and it'll send a text to your phone or an email when the stock has come back to the fair value price, which is changing every day as our algorithm works out what a fair value for the price should be, and uses a lot of different fundamental data and Wall Street analyst earnings expectations as well. And as far as we can see, that's the only stock fair value indicator on TradingView, and has been a really popular one with our customers. So head on over to our website and check that one out if you haven't already. Pinterest came off hard after earnings as well, down 15% today on huge volume. And just checking in on First Republic here, after hours as I speak, we're down 45% to $1.93 a share. And this is a great illustration of how quickly things can change in the markets. It was only 2 months ago that we're up at $140 a share, even a bit higher. And that's why it's important that you always have a stop loss strategy and risk management. You should always be diversified. For our portfolios, we don't put more than 7.5% of the portfolio into any one position. Because as we've seen here, as what we thought just a couple of months ago was a solid stock has actually now been completely wiped out. And if you've been following this channel, you saw me mention that First Republic never managed to close above its 50 bar VWAP, which we watch. And that was in contrast to the others, PacWest, which just managed to, and Western Alliance, which is still above its 50 bar, and the big banks as well, Bank of America, Citigroup, and Wells all got above it. However, Charles Schwab has still yet to close above its 50 bar, so this thing is not out of the woods just yet. And that's a look at all major market categories. Let's go back to the main indices for our final outlook. Okay, so the big mega cap tech dominated indices are sitting at highs here. We've actually got the NASDAQ breaking out to a new year-to-date high today. However, we do have divergence forming on our hidden divergence indicator, and for the S&P 500 as well, and the gap between this yellow line, the global net liquidity model, which I follow closely and represents kind of the liquidity out there from global central banks, which the stock market has correlated really closely with ever since COVID. We now got over a 300-point gap here, and that's coming up to an extreme, and in my opinion, this acts as a bit of a weight on the market. However, we're just looking at the S&P 500 and the NASDAQ, you're really just looking at those big mega cap stocks. What you really want to pay attention to is the S&P 500 equal weight, which weights all 500 stocks in the market equally, and we can see that's diverging down as well. And same with the NASDAQ equal weight as well. That's tracking sideways, nowhere near its new year-to-date heights. It's still well below the February 2nd high. And when you look at the mid-cap index as well, and the Russell small cap and micro caps, which are still trading down near their lows. So overall, most stocks are still struggling and going sideways here with a lot of overhead resistance and pressure on them. Again, just looking at the heat map of the year-to-date performance of stocks, and we can see Apple up 30% year-to-date, Microsoft 28%, Amazon 25%, Tesla 33%, Meta a double, NVDA 90%. So the big indices are really just being pulled up by these real big guys performing exceptionally well. So it doesn't give you a really true look at the entire market when you're looking at the SP500 and NASDAQ. However, just looking at a clean monthly chart here with no indicators of the S&P 500, we can see we are around this kind of resistance zone after we've done a pullback. And if we just draw a Fibonacci from the move down from the start of the bear market, we're sitting right at that 50% retracement. So this could be a 6-month retracement of this bear trend, and I still think there's a good chance that we resume this downtrend, even in the big mega cap dominated indices like the SP500. So given all that, I still remain 60% net short. However, NVDA is the only big company that I'm short. I'm not shorting any of the other big companies. And we'll continue to watch the earnings roll in next week. And so far, they've been doing pretty good. And I say that's what's helped the market out the last couple of days, especially with the big guys. But we are at big resistance zones here. And that sums it up for the day and month. Thanks very much for tuning in. If you haven't already, hit that subscribe button. And I'll keep you updated every day with the most important market data, analysis, and charts. I hope you have a great weekend, and we'll see you again on Monday afternoon. Thanks.